Good afternoon, ladies and gentlemen, and welcome to this, the 114th Annual General Meeting of the company. My name's Andrew Ross, and I'm the Chairman of the Board. It's now just after 2:30. We had to wait for the music to stop. And I'm pleased to confirm this meeting is now quorate, and we can now proceed to business. I'm very pleased that after 2 years of COVID-related disruption, we're once again able to be hosting this meeting in person today. However, additionally, I would like to extend a warm welcome to those shareholders who've taken the opportunity of joining the meeting virtually, which explains the Hollywood-like lights shining on us. This is our first hybrid AGM, and I hope that this has enabled a number of you who are not able to get here in person to join us today. I also hope that your chairman's ability to multitask will be sufficient to guide us through what for Witan is a groundbreaking innovation. The world is a very different place from when we last met in 2019. COVID restrictions meant that in 2020 we had a closed meeting. In 2021 we had a Zoom version of the meeting. And the influence of COVID on global economies and markets has also been a major factor in providing a difficult backdrop for your company to navigate, as Andrew Bell will explain shortly in his review of 2021. So the format of today will start with a presentation from Andrew Bell, our Chief Executive Officer, followed by a Q&A session with him and myself. After this, we will move to the formal business of the annual general meeting. I'd just like to run through two admin points before we start. First of all, by asking that you can all hear me, and I think that's very unlikely. I think people can hear me across the road. This microphone sounds so loud. But if at any time that's not the case, please raise your hand. And secondly, copies of the notices of this annual general meeting have been circulated, and with your permission, I ask that the notices of the meeting are taken as read. So I'll now hand over to Andrew for his presentation.
Thank you, Mr. Chairman. And as the Chairman said, good afternoon and welcome to our 114th Annual General Meeting. It seems like, in some ways, a lot more than 1,100 days since we last met in person. What I'd like to do is to give a brief summary of our results for 2021, the main changes we made to the portfolio, not as many as in 2020, but from a different starting point, and some thoughts on the present outlook, accompanied by slides which will appear behind me, or for those who are joining online, on your screens. And I'll hope that the screen that I think I'm talking about is the one that's behind me. So I'll have a quick look over my shoulder every so often. Well, clearly, the first thing to note is that the outlook is more than unusually uncertain, owing to the continuing effects of the pandemic, and notably in recent months due to the recent Russian invasion of Ukraine. Quite aside from the grievous suffering that was inflicted on, and is still being inflicted on, the Ukrainian people, the resulting disruption in energy and other commodity supplies has compounded inflationary pressures which were already at their highest levels for several decades. And we'll come back to that later. So, first, let's have a look at the 2020 results. 2021 results. 2021 was a very strong year, an unusually strong year for global equity markets, led yet again by the US market with its relatively high technology weighting. Vaccines enabled many economies to reopen after the winter shutdowns of just over a year ago, with pent-up momentum, and both fiscal and monetary policies delivered a further stimulus to economies that were already running at quite a fast pace. Witan's NAV total return, as the slide shows for the year, was 15.8%, while the share price total return was 11.8 or 11.9, as our shares ended the year on a wider discount than at the end of 2020. Both were well ahead of longer-term average equity returns and obviously well ahead of inflation, which was fairly low for most of last year, although our returns were less than the 99.9% return from Witan's equity benchmark during 2021. Our dividend per share increased by 2.8% to 5.6 pence, partly funded by drawing on our retained revenue reserves, although by less than we needed to in 2020. Despite the lagging performance, as the chart shows at the bottom, despite the lagging performance in both 2020 early and 2021 later on, over the longer term, our 10-year returns remained ahead of our benchmarks by a little, but at least we're keeping pace despite the recent travails. Well, during the year, our NAV total return, which is the blue line on the chart, was on a fairly consistent upward trend. And in relative terms, which is the green line, it was ahead of the benchmark for most of the year. But unfortunately, and really rather frustratingly, this slipped away in the final 2 months of the year when broader economic confidence, particularly outside the US, wavered in the face of rising inflation and the rapidly spreading Omicron variant, which people feared was going to put the whole of Europe and the UK back into lockdown. The following slide shows the contribution. It's a bit involved to read in detail, but all the slides are available on the website, so for anybody who wants to study them at greater leisure, the detail will give many hours of enjoyment, I'm sure. But the slide shows the contribution in pence per share on the graph, taking us from the end 2020 net asset value of 236 pence to 267.4 at the end of 2021. Principal driver was the portfolio gains, which are the first two bars. The two green bars are the capital gains and the income from the portfolio. And gearing further boosted returns, and there was also a contribution from buying back our shares at a discount throughout the year. The two grey bars show the deduction of running costs and interest payments for the year, and the pink bar represents dividends paid out to us as shareholders. The table on the right, I think, probably does need to be studied, at closer quarters, and shows how you start from the portfolio return at the top, the contribution from gearing, the contribution from, or the impact of costs and so forth. And what it shows is that the major issue for our performance during the year was that the portfolio at the gross level, before costs and the impact of gearing and buybacks, underperformed. And we'd normally hope for better from our external portfolio managers, as their underperformance, for which I am accountable to you, was the source of Witan's overall shortfall against the benchmark during the year. This slide shows the benefits Witan has derived from gearing over the past 10 years. The blue bars show the contribution as a percentage of net assets after interest costs. And although gearing, it has to be said as a caveat, in a bad year, gearing can exacerbate losses when you have a down year such as 2018. It can also complicate navigation during the sort of choppy year we had in 2020. But generally speaking, either through the benefit of the timing of use of gearing, or if you have markets which more often than not rise, gearing can amplify returns. And as the chart shows, it's very clear that over the past 10 years, the blue bars above the line add up to an awful lot more than the two blue bars below the line. The pink line is also, I think, of interest because it shows our interest costs as a percentage of net assets each year. And this is reduced from 0.6% a decade ago to 0.3% in 2021, as the interest rate on our fixed-term debt fell from over 7% to under 3% now. This trend is important because it reduces the hurdle rate for our portfolio returns to be able to beat the cost of borrowing, and therefore it makes it easier in the future for gearing to contribute to our returns, even easier than it may have been in the past. And furthermore, as we stand now, the majority of our borrowings is now fixed for the next 25 years, at a rate of under 3%, just over 2.9. And we believe this looks increasingly attractive now that UK interest rates have started to rise significantly, and the Bank of England raised rates by a further 0.25% today. Rates do remain very low, but still historically, well below what they could reach in a normal cycle. The next slide summarizes some of the engagements we've taken on in the field of responsible investing as the sort of overall heading that it would be, which often also goes by the sort of the three-letter acronym ESG, which is environmental, social, and governance issues. Well, investing in well-managed, soundly financed companies with good return prospects is, of course, not exactly a new idea. After all, nobody would say that they were trying to seek the opposite. However, there's been a very substantially increased emphasis on the sustainability of returns in the light of evolving expectations for corporate behavior, changing regulatory requirements, and the threats and the opportunities presented by climate change and the international commitments to try and mitigate its effects. And Witan, as that succession of letters in the bottom right-hand corner shows, or symbolizes, is determined to play a full part in these initiatives as part of our central task, which, to be clear, is to deliver competitive and enduring investment returns for our shareholders. We've committed that our portfolio will have zero net carbon emissions by 2050, and we will set and report against interim targets towards that milestones towards that target in the meanwhile. We also regularly engage with our managers to monitor the structure and effectiveness of their evaluation of all of the risks, including environmental, social, and governance, in selecting investments. And where there are specific incidents, and we have a number of monitoring tools to bring these to our attention, but where there are specific incidents of reported corporate shortcomings, they're taken up with the relevant managers, and those managers take them up with the companies directly, and that will either produce a decision to change the nature of change the size of the investment, to disinvest, or ideally it will change corporate behavior. That, after all, is what's going to improve the environment, is for if you like, the miscreants to reform rather than everybody to sell the miscreant shares to somebody else who doesn't care so much. Well, all of our managers are also signatories of a charter called the UN's Principles for Responsible Investment, and 4 have already signed up along with us to the Net Zero Investment Managers Initiative, targeting zero carbon emissions by 28 years' time. Our additional commitment made recently is that our portfolio will consist entirely of sustainable businesses by 2030. And that reflects our belief that without sustainability, the returns from businesses are built on sand. Either the business will itself be competed away or go out of business, or it'll get into such trouble with the authorities that the returns from shareholders melt away. So sustainability in our books goes hand in glove with our commitment to deliver enduring returns to shareholders. We're also committed to reporting more fully to shareholders, should they care to look in detail, and to other external bodies on our progress towards meeting our targets for sustainability and reduced carbon intensity. And further details can be found in our 2021 annual report and accounts, and of course on Witan's website, and those are periodically updated. More tangibly, also during 2021, we substantially increased our investment in a climate change fund, which has actually been one of our best performing investment managers over the almost 3 years that we've held it. And we also made a new investment in a sustainable energy fund at the start of last year. Turning to dividends, 2020 was a big shock for anybody who had significant portfolio investments in the stock market, because dividends didn't simply flatline or go off by a quarter of 2 or 3%. They dropped by almost 50% at one stage in the UK market, and that was, I suppose, that was partly driven by corporate stress, and it was partly driven by the actions in the authorities in, for example, forbidding the banks to distribute dividends in case their capital was needed to cover bad debts caused by the sort of recession that people feared would happen after the lockdowns. But 2021 saw underlying portfolio dividends recover fairly significantly from the cuts that were made in 2020. And Witan's dividend, as mentioned a few minutes ago, rose by 2.8% to 5.6p, which marked the 47th consecutive year of rising dividends. This was partly funded by using 14.6 million of retained revenue reserves, down from the 19 million used the previous year. And the chart shows that despite more modest growth in 2020 and 21, Witan's dividend per share over the long term has grown much more rapidly than inflation. The figures for the last 10 years are inflation about 21% and our dividends risen by about 133%. And the board's policy remains within an overall objective of delivering competitive total returns. We're not just trying to chase income, but the policy remains to achieve long-term real growth in the dividend, making use of our retained revenue reserves where needed, albeit that depending upon markets, dividend growth in the next few years may be slower than the 10-year average as dividend cover continues to rebuild towards our objective, where we would like to see the dividends we paid out covered by the dividends that come in from the portfolio. That way we know we're not eroding the capital in any systemic or significant way. The next slide shows the sort of not meant to be a spider having been dipped in ink and randomly walked across the page, but it could look a bit like that. It's the 10-year discount chart, which our discount in days gone by used to trade in a sort of 10 or 12% range, and then we had a 4 or 5 year period when we were close to parity, even issued shares at a premium on for a couple of years. And then in 2020, I think the shock of the pandemic led to a significant widening in our discount. As you can see, the sort of plunge from something like 2 to about 8%. And that persisted through in 2021, although it did stabilize at an average of around 7%. And there are a variety of causes. Part of it was genuine apprehensive sentiment, and people were more inclined to sell in the face of the pandemic and the economic uncertainty that followed it. Part of it was that our own performance was pretty wobbly in the first few months of 2020. But there's a more structural reason which we've also had to cope with, which is that for a range of reasons, not really related to investment, some institutions are less willing than before to hold investment trusts. And that's resulted in a degree of selling pressure at a time when the confidence of personal investors, who make up the majority of Witan's shareholders, was affected by economic uncertainty from the pandemic, and of course more recently due to the war in Ukraine, and which has exacerbated the already fairly intense rise in energy costs. Well, our response to this widening in the discount is that we stepped up the pace of our share buybacks. We bought last year 64 million shares, which was about 8% of the starting total, at an average discount of about 7%. The resulting NAV uplift was £10.7 million. And for perspective, in case that doesn't seem a lot of money, this exceeds the total investment management fees paid to our external managers and thus offset the majority of our ongoing charges for the year. Warren Buffett, he's obviously well known for a lot of very smart investment aphorisms, but one of the things that he quite likes repeating is, whether it's stocks or socks, I like to see quality goods when they're on sale. And although decisions by individuals about whether to invest in Witan should be based on a broader range of considerations about whether it suits their needs and objectives, mathematically, a higher discount offers a better value proposition than a narrower one. And Witan has also consistently been more active than most of its peers in buying back its shares, not simply on periods like the last year or two when the discounts been 6, 7, 8%, but even on narrow discounts we used to buy back our shares. And it remains a longer term objective for our shares again to trade at a sustainable low discount or a premium. The next slide shows how the portfolio is allocated between managers. Again, apologies for a lot of detail. It's a table which is lifted from the annual report and it clearly can be studied at greater leisure. What I wanted to sort of just clarify is that there's a split between what we view as the core and the specialist areas of the portfolio. 3/4 of the portfolio is allocated to mainstream or core managers. 5 of them, who add up to 70% of our assets in total, have a global equity remit, 1 a UK specialist, and that proportion reflects the dominance of global markets in our benchmark. And their task is to deliver returns ahead of their particular assigned benchmarks, the MSCI World in one case, the MSCI UK market in the other case. And although the majority have done so, as can be seen in the penultimate column, since they were appointed, they failed to do so in 2021, unfortunately. The remaining 25% of the portfolio in the lower half of the table is allocated to specialist managers, for example, covering emerging markets or climate change, with up to 15% invested in specialist collective funds, something we've been doing for the best part of the last 12 or 13 years. Specialist collective funds in areas such as listed private equity, life sciences, biotechnology, commodities, and property, according to opportunity. And those are typically outside the remit of the mainstream managers. And the purpose of this 75-25 split is for the core managers to deliver the bulk of our exposure to companies which are selected from the major indices in our benchmark, while the other 25% allows Witan to benefit from areas of more specialized interest, which have either got longer term or more tactical attractions. These 2 slides show the portfolio breakdown both between geographical regions and industrial sectors. Witan's exposure is shown in blue and the benchmarks in green. The portfolio is actively managed rather than managed to fit the exact skyline of the benchmark, and far from it, and so its makeup differs materially from the benchmarks. Geographically, although the US is the largest proportion of our portfolio, it's just under 40% in that chart, slightly higher at the moment. We've tended to have significantly less in the US than in our benchmark due to the company-specific choices made by our managers. And this was costly to performance for much of the past 2 years when US technology stocks led markets higher. Our long-standing overweighting in the UK was a significant headwind during 2020. It was broadly neutral last year, and the UK has outperformed in 2022. The second chart, which I defy almost anybody to be able to read, let alone translate the code of the x-axis, shows that we have a very widely spread sector exposure, with a tilt towards more cyclically sensitive areas and away from the major technology giants. Although these 2 charts illustrate the diversity within Witan, the managers construct their portfolios based upon the merits of individual companies rather than according to a country or a sector template. Now turning to subsequent events and the future. That's the future. Now we'll go on to subsequent events. In the early part of 2022, as we know and live through with every news bulletin, markets have been dominated by 2 themes: rising inflation and interest rates, and the effects of the Russian aggression in Ukraine. Initially, Witan's portfolio, as this chart shows, again, the blue line is the absolute value of the portfolio, the green line is the relative value, and it's clearly, unlike most of the last decade, it's so far been a falling year for equity markets, and indeed for bond markets, which I think have caught even more of a cold. Anyway, initially, until about the middle of February, Witan's portfolio, while lagging behind a little bit, was relatively resilient, as January's falls were concentrated in technology, the most highly rated areas of technology, where we tended to be underrepresented, and some of the cyclical sectors, such as the banks, that some of our managers are invested in, and some of the engineers, performed quite well because the market began to be more hopeful about economic recovery as the Omicron epidemic of the coronavirus showed signs of being less serious and of beginning to wane, with less effect on economic activity than the lockdowns in either of the previous 2 years. So, however, this sort of benign period of thinking, well, we're holding up okay, changed with the Russian invasion, which prompted further and quite steep falls in equity markets generally and in Witan's relative performance. At one point, in very early March, in the first few days after the shock of the invasion, our NAV total return was down about 14%, and we were 6 or 7% light of the benchmark's returns. And at the end, by the end of April, which broadly is the same position today, our NAV total return so far is -9, which is about 5% behind our benchmark. So some improvement in recovery since the lows, but more to do, and we're very conscious of that. The two principal drags on our performance recently have been exposure to areas exposed to benefiting from cyclical recovery, and our underexposure to oil stocks. Many active managers tend to be quite suspicious of investing in the oil sector, which for most of the last decade or so has been the right way to be, because you're trying to invest in companies possibly in a declining industry because all the pressures to try and move from fossil fuels to sustainable, but also in an environment where one of the major determinants of stock market success is the oil price, and the oil companies have no influence over the oil price. So it tends to be an area where many active managers are relatively allergic to exposure. But of course, in a year when you have substantial inflation in energy, partly because countries have underinvested in fossil fuels for a few years, the consequences of that has been that there's a shortfall in the availability of oil relative to demand, which cannot be met by the rapid growth in sustainable energy forms. So there's for the best of motives, we ended up with a difficult situation where the rapid pace of recovery at the end of last year produced an intense rise in demand for fossil fuels, which the major producers were either unable or unwilling to meet. And that, of course, has been exacerbated by the Ukraine invasion, which has led to disruptions in the oil and gas markets in terms of wanting to avoid buying supplies from Russia, and and indeed other commodities. So cyclical recovery hopes have been set back clearly by the steep rise in energy costs, which squeezes our incomes as consumers, and by fears that central banks, and this is perhaps a more enduring concern, we don't yet know the answer to this, but fears that the central banks, who spent most of last year saying that inflation was transitory and they didn't need to move from zero interest rates, I think have realized that there is and hindsight's a wonderful thing, so I wouldn't sort of stick my tongue out at them for having misread it, but have realized that there is going to need to be a more material rise in interest rates in order to prevent the recent rise in inflation from becoming entrenched in people's minds and becoming a wage price spiral, which then becomes very costly to try and overturn. But the concern is that because the central banks may over-aggressively tighten monetary policy as they try to correct for having underestimated the inflation pressures in late 2021. And of course, the high inflation has been given an additional twist by the rise in not simply energy, but also wheat and other commodity costs. I think Russia and Ukraine between them I think account for something like 40% of global wheat exports. So, and of course, food is a very politically charged thing. If you have food costs going up, particularly in relatively poor countries, that often leads to the sort of riots that produce changes in regime. So it's become quite a wobbly period economically. Our managers, or some of them, have overcome some of their reluctance to buy energy stocks over the last few months because it became relatively evident that the world needed fossil fuels, even if it didn't feel very good about the fact that they did need them. And clearly, defense stocks have moved back into the limelight. And so although we've increased our exposure in both of those relatively topical areas, our overall portfolio remains primarily positioned to benefit from a resumption of moderate economic growth later in 2022. And although this positioning has not been at all helpful in recent months, actually it was most unhelpful during mid-February to mid-March. Since then, broadly speaking, well, you say we've slightly recovered some of our underperformance, but the attitude towards cyclical stocks, I think, has begun to become a bit more discerning, where areas such as retailers and some of the reopening restaurant and travel stocks have come under pressure because people think that there's a lesser likelihood of people traveling, or if energy is going to put a squeeze on people's purchasing power, they won't go out for a meal quite so often. But other areas, such as the banks, have prospered quite well. They haven't done as well as their share prices, but they've performed reasonably well because an environment of rising interest rates enables the banks to cover their costs more easily and to expand their margins, provided that it doesn't tip over into a recession when the banks lose money through bad debts. But one of the features over the last 6 weeks or so is that the trading performance of many companies in our portfolio as in the corporate results, have been a lot better than their share prices, suggesting that the market may be underestimating their prospects. And in the end, and another Buffett aphorism, you don't know when it'll happen, but in the short term, the stock market is a voting machine, and in the long run, it's a weighing machine. So if the results keep coming in, the share prices in the end will come into line with that. So the next slide shows, I think, yes, that despite these, just a couple of different ways of looking at longer term performance, but shows that despite the weak outcomes in relative terms in early 2020 and later in 2021, our performance in the 10 years to the end of 2021 was in line with or just above the benchmark, with the caveat that neither good nor bad performance should be viewed as a guide to the future. We have to say that. And the following slide shows the performance over the past 5 individual years to March each year with the same caveat. And you can see from the bottom line which shows a year of modest outperformance, small underperformance, substantial underperformance, very substantial outperformance, and then substantial underperformance. It's been a very volatile period to navigate through, and we would hope that, who knows when the world will settle down, but we would expect that in the medium term the swings in those relative performance would both net out to a more positive number and also become less volatile. Well, finally, if that's the sort of word everybody always likes to hear when I'm making a presentation, with the caution that prediction is particularly hazardous at present, this slide summarizes a number of points that we think are going to characterize economic activity over the balance of this year, and some of the key influences on economies and the markets. It's hard to read, but again, available on the website. The economic reopening that everyone was looking for after the peak in the Omicron variant cases it's happened in countries like the UK, less so in Europe, and has been clouded by lockdowns in China. China has a problem. I mean, they have a different attitude to trying to cope with and suppress COVID, but one of the reasons that they don't have the option, there are perhaps 2 reasons why they don't have the option just to say, okay, let's just see how it goes. Let's live with it. Let's treat people who get ill and so forth. Part of it is they have very low vaccination rates, particularly among the older part of their population, whose average level of health may be less than people who have lived through their whole lives in a relatively prosperous environment. So the risk would be that a runaway epidemic could produce very high mortality. And that has a big political complication, partly because Xi Jinping, the head of China, has made it his policy that we can suppress it by, isolating everybody and so forth, partly because he's facing a final political hurdle to becoming president and commander-in-chief for life in a party conference later in the year. And clearly, if the backdrop was of a runaway COVID epidemic where tens of thousands, if not hundreds of thousands of people were dying, that would be detrimental to his chances, which is not really the most important thing in the world, but it does explain why they're trying to cope with COVID by an absolute lockdown policy where the rest of the world is trying to feel their way towards a balance of restrictions and freedoms and vaccinations. Anyway, so that's the reopening has been set back somewhat by the lockdown in China, the significance of which is an awful lot of components for supply chains are made in China. So the contribution of supply chain disruptions from to inflation, which people thought was past its worst at the beginning of the year, is going to have another peak over the next few months. And it's also the recovery, the economic recovery that we were all hoping would be really in full swing by now has also been clouded by the uncertainty and inflationary consequences of the Russian war on Ukraine. Interest rates have started to rise quite visibly, and the vocabulary from all the central banks, even Europe, where rates remain negative, has been very much about interest rates starting to rise earlier, likely to rise faster. And the concern is, as I was alluding to earlier on, that because inflation is so high, they may have to keep on raising interest rates even if growth comes under pressure. Whereas for most of the last 10 or 15 years, inflation has been low. As soon as there's a bit of a market panic or a bit of a slowdown, the Fed's been able to put its foot on the accelerator again. That is a less safe thing to rely upon this time round. So there is a growth worry in the background. Energy prices are a particular threat, obviously directly affecting disposable incomes, as well as exacerbating the inflation problem. On the positive side, and there is a positive side, there remains substantial pent-up demand from the enforced savings that many people have been able to make over the last couple of years when they weren't able to spend their money as they wanted. Wages are moving as well as prices, so we don't quite know where the baby is going to be left in terms of the impact of inflation, but it isn't all falling on the wage earner. And fiscal policy remains accommodative in a different way, that there's a lot of money being put towards mitigating the effect of the rise in energy prices. And in the medium term, there are very substantial capital investment spending programs directed at either building or rebuilding infrastructure in the developed economies, and also at moves to electrify the economy and to back out fossil fuels from the transportation and electricity generation businesses. So there is good and bad around, and I suppose it's a bit like going for a walk in the country. You have to balance admiring the scenery in the sunlit uplands with avoiding tripping over a molehill and landing in a cowpat. And despite having had our share of cowpats over the last year or two, we have to retain a long-term perspective in investment terms, where we're focused on trying to find good quality, well-managed companies with relatively forecastable growth prospects, and focus on the business prospects of the companies rather than the incoming shorter-term news. And although we and our managers have found the changeable circumstances of the past 6 months particularly trickier to navigate than we would have liked, we cannot steer using the rear-view mirror, and we hope and expect, having met or reviewed all of our managers in the last 3 or 4 months, We hope and expect that shareholders will see better relative rewards from our managers and from our net asset value total return over the coming year. And in the wake of that, as long as the rest of the sector isn't sitting out on a 10% discount, we'd also hope that the discount comes in as well. So thank you for listening to that rather extensive sort of tour of the macro environment. And now, as the chairman said earlier on, we're very happy to handle any questions.
Thank you, Andrew. So we'll now turn to taking any questions from you on Andrew's presentation, on the annual report, or indeed any other business of the company. In addition to Andrew Bell and myself, we've got present on the stage here the Chairman of the Audit Committee, Jack Perry, the Chairman of the Remuneration and Nominations Committee, Paul Yates, our Senior Independent Director, Susie Newbert, and the other non-executives, Rachel Beagles, Gabriel Boyle, and playing on the right wing, Ben Rogoff. If you wish to ask a question, could you please raise your hand and wait for a microphone to be brought to you. Before asking your question, if you could give your name and, if appropriate, the name of the shareholder or company which you're representing. If you're watching online, you can ask a question by typing the question into the chat function within Zoom. Eleanor, who's our outstanding company secretary, didn't have in her job description being a compere online, but she's about to learn how to do that.
Thank you, Chairman.
Questions?
I have real ethical problems with investing in companies in Russia and China. I wonder what Witan's exposure is to companies in both of those countries, and also what your continuing attitude would be in the light of, what's unfolding. Thank you.
The position, just to track over the last few months, I mean, Russia as a market, I mean, clearly we know more about the risks of investing there and the appalling political governance of the country than we did a few months ago. But at the beginning of the year, Witan had approximately £25 million, which was about 2% invested in Russia, mostly through our global emerging markets manager. He sold half of the exposure during the course of January and was still trying to sell a little bit, albeit at much lower prices, during February. But at the end of February, when effectively the markets in Russia closed, we had approximately £10 million or so value of stocks, which we're now valuing at zero. We haven't been able to sell them. We'd like one day to be able to do so. Who knows when that will come. We've established with all of our managers that they will not, in anything like the current circumstances, invest in Russia. The reason people view, it's not new that Russia's a pretty smoky place and a lot of corruption and so forth, but it had a lot of exposure to commodity producers and oil producers on much lower ratings than was available elsewhere. I think that was the appeal, although it was an appeal that almost exclusively went to the emerging market manager rather than to the other managers. So the only exposure that we had at the end of March, and we don't know whether that still exists, was in a unit trust that we hold, which out of a £110 million investment had about £200,000 invested in I think a US-listed Russian stock. So it was from our point of view, it was like 0.1% of our assets, so it was an inconsequential amount, and they were probably in the same environment that they couldn't sell it. So I think the governance question that you raise is something where the bar to, I mean, if Putin suddenly walks out, that doesn't mean we're all suddenly going to think, well, Russia's got to be a good place to go and invest, because, you know, when somebody's lost their reputation and you know, once you're aware of risks, you have to be able to dismiss them for the future rather than just sort of move on as if the past didn't exist. China, I mean, clearly there's a whole spectrum of places. There are greater risks in China because of the degree of the political control overlaps with the operation of the economy. Frankly, there are an awful lot of countries where there is, there is political risk and so forth. So we have relatively little. I mean, our emerging market manager has some exposure to China, but it tends at the moment to be away from the technology stocks where the political interference appears to be greatest. Nearly all of our other managers have either zero or negligible direct exposure, but that's by choice. I think, as part of our engagement, we were talking about ESG earlier on, and clearly when people talk about G, they normally mean, is the company being managed honestly? Does it, has it blown up an archaeological site in order to develop a mine or behaved badly? It's not usually the governance of the countries they operate in or they're based in. But that's clearly going to be more front of mind in the engagements we have with our managers in future. Are you sure that it's, is it worth the candle to have 1% of your portfolio in Pakistan or wherever it happens to be, Eritrea? But bar Russia, which clearly at the moment we have a prohibition on investing in, even if we were able to, we're aware of the risks, but we wouldn't quite bracket China. We think China is a commercial country run by an authoritarian government, whereas Russia is a kleptocracy where it's very difficult to see anybody being able to earn returns other than at the discretion of Mr. Putin and a few of his acquaintances. I won't say friends, because they're probably all in jail and no longer his friends.
Thank you. Yes, down at the front here, please.
Yes. John Crawford, private investor. I wanted to raise the fact that your number 3 share in the portfolio is Unilever. And it's quite a hefty holding you've got. I was at the AGM yesterday, and I was very disappointed in the management because the company has been doing very badly in the last year or so. Tell us what you have been doing in negotiations with that big holding. Have you met the management?
I might throw this over to my colleague James Hart, who might know slightly more of the detail. The answer is that we would tend not to meet the management of investee companies directly because the stock picking is done by, I think in Unilever's case, 2 or 3 of our external managers. But we would expect them to be, and we have in fact already a couple of, say it seems like a couple of months, it was probably mid-March or so, when this, the topic came, there was a sort of initial controversy over why hasn't Unilever withdrawn. And their public statement at the time was that they had stopped importing any products to Russia, they'd stopped exporting any products from Russia, but that they were continuing to manufacture products in Russia, paying their Russian workforce for purchase by Russian consumers. And the debate may have moved on, but their argument was if they closed it down, they would be, or I'm supposing their argument would be that would punish their workforce, who weren't responsible for the political decision, and that there was no trade benefit from their business in Russia, for Russia, and they were also operating the business on a nil profit basis. Now, I imagine things may have moved on, and I haven't caught up with I've seen 1 or 2 news headlines today about people, thinking Russia is a place they shouldn't be doing business. So I don't know whether, James, you can add anything to our engagement with the managers on the topic.
Yes, now it is working. Okay, good. Unilever is owned by 3 of our outsourced managers. And aside from the engagement they've had on the Russian exposure that Unilever has, obviously they've been engaging with that company over the last few years. You'll recall that Unilever tried to move headquarters from the UK to the Netherlands, and more recently tried to acquire a business from a competitor in the personal health space. As part of our engagement activities with our managers, they must report to us on a regular basis the engagement that they've had with their underlying companies. And Unilever is a good example of this, because you might recall that one of our managers was instrumental in helping stop Unilever move from the UK to the Netherlands. And they report to me, as my colleagues, on at least a quarterly basis, and sometimes even more regularly than that, in terms of their engagement. Their outlook is that they've been disappointed by some of the financial performance at Unilever, but they remain confident in the long-term prospects for the company.
Just behind where James is standing there, yeah, thank you. Yes, sir.
David Adler, I'm a shareholder. Just to add, I was also at the Unilever AGM yesterday, and Andrew Bell is perfectly correct. Nothing has changed from your view of what their motives and current policy is in regards to Russia.
Thank you. I'm going to take one question just to prove that people are out there. Albeit not a particularly nice question. Why should I continue to invest in Witan when it is consistently outperformed by most global index funds? I think there are two aspects to my answer. Firstly, clearly, Witan is not competing directly with a global index. We've got an index that is partly the UK market and partly a global market. And secondly, in the 25% of the portfolio that Andrew described earlier on, we're obviously trying to do very different things from a global index fund, which we hope are things that a private investor will find difficult to do on their own. Having said that, over the very long term, I think you should expect us to do better than a global index fund. Clearly, having gone through the 2-year period that Andrew has just described, that is not the case at the moment. But over the long term, we certainly would aspire to do better than an index fund.
I'd add to that over the last 4 or 5, or probably 5 or 6 years now, in fact, since the Brexit vote, we were hampered relative to people who were purely 100% global, because the UK market, which in the previous 10 or 20 years had been pretty competitive with other global markets, went into a very consistent and multi-year relative decline. And that was partly because the sector mix was seen as a bit stodgy, because at the time nobody wanted oil stocks and the banks were viewed as mature and boring. But also because people wrote off investing in the UK until they could see how our economy would be affected by Brexit. And so, effectively having, as we did, a benchmark which at the time of Brexit, was about 30% UK, and has been gradually reduced since then, was hand-tied behind our back relative to global indices, even though we would explain we weren't trying to, what we put on the tin was we have 70% global, 30% UK. So, in fact, a couple of years before that, we were 40% UK. We listened to our shareholders, though, because it wasn't simply a matter of, UK hasn't performed, therefore you should get out of it, because that's usually investing using the rear-view mirror is a poor guide to future action. But it became clear that a number of our shareholders said, well, we can buy UK stocks individually, we can buy lots of UK funds. What we find it harder to do is to spread our research or analysis across the whole ambit of global markets. So, if you like, what people wanted to retain was the global reach, and to have less of the purely UK bit that people could do themselves. So we have gradually moved to a position where now our benchmark is, if you look through both bits of it, is about 18% UK and 82% global equities. We may also have reached a stage where the UK is no longer doomed to underperform the rest of the world. If you take sector, apart from the fact that the oil sector's obviously discovered some sort of new dawn, at least for a while this year, sector by sector, the UK consistently rates cheaper than similar sectors in Europe and in North America. And there have been signs over the last sort of 3 months, but actually to a degree over the last year, that people are beginning to come round to that. I think they're still rather shy of buying the UK, but the fact the UK is outperformed and is actually up on the year to date and performed in line last year, having been 10 or 12% behind the previous year, indicates that having a slightly UK heavier benchmark may not be a disadvantage. But the question is quite right. If we can't deliver performance in the longer term, then something would have to change, and that's what we're committed to doing. We're very open internally, and I wrote a note a couple of years ago when just after we'd had a very sharp period of underperformance through the initial lockdowns, which was, people said it was relatively rare for a fund manager to apologize publicly for having, as it were, developed a reverse Midas touch, where everything he touched turned to lead. So we're very personally determined, but also have been, when you look at how a manager or how a fund has done, you can't either benefit or suffer from yesterday's performance. You have to form a judgment about the future. And when we've looked at the managers, although we have changed the number over time and we've changed allocations between them, we retain a belief that in normal times where the stock price is determined by the performance of the business rather than by big changes in market sentiment driven by macro factors such as pandemics and wars, in those times we think that those managers retain the talent, which was why we originally selected them. And we've shown that we are very willing to make changes if we lose faith. And as the board are all shareholders, it's my largest personal shareholding, so I'm very determined to turn around the performance and make next year's return to the AGM a much happier and more joyous celebratory occasion than this year's slightly contrite performance.
I've got one more question online, which relates to dividend cover and is coming your way, Andrew. The dividend has not been covered for 2 years. This has not been a problem as the Trust has very significant revenue reserves. When do you think the dividend will become covered?
Well, that's...
Thought you'd like that.
Yeah, well, the dividend cover in 2020 was 56% or so, i.e. just over half of the dividend was covered by 2020's earnings and the rest was paid out of reserves. The figure for last year was 65%. It depends on a number of things. Obviously, what the performance of economies is, how our portfolio dividend growth comes, and how much our managers change from one type of stock, which might be paying more dividends, to another, or to a lower yielding portfolio, or vice versa. But we produce a model of these things, but recognizing that, as I can't remember who it was, but somebody said, never make predictions, particularly about the future. But you have to make a plan, and the plan that I drew up in the middle of 2020 said that on the basis of a number of assumptions, it might take 7 or 8 years for our dividend to return to being fully covered. And so far, it looks now as if our dividend will be fully covered by 2027 on the basis of that model. But the assumptions within the model are much more conservative. I.e. I'm assuming much lower dividend growth, and I'm assuming something like a reasonable rate of dividend growth per year for Witan shareholders. So if I had to bet, I think it will be sooner than 2027. But through the period from now to then, I think we will be able to make up the gap between incoming dividends and paid out dividends from our revenue reserves. And that, again, is a better position than 18 months ago, where it looked as if we might, for a couple of years, have to make use of capital reserves. It now looks as if we won't have to. But I would say that there is a more robust and full-throated 2 or 3 years of decent economic growth, and when companies themselves become more confident paying out money, which, like the banks, could pay much higher dividends than they are at the moment, but they're holding back because they've had a couple of shocks in the last few years and obviously don't want to pay higher dividends then have to cut them. And also there's probably some political backlash if it looks as if fat cat shareholders are doing too well out of, rising interest rates. So the thing that reassures me is that there is a very steady progression within our original model from 50% or so dividend cover to 100% by 2027. And that progression has become, now depends upon less optimistic forecasts than we made at the time. But I'd also say that our focus in investment terms is total return, but the benefit of a dividend is twofold. The first is it's a reality check on whether you're invested in a portfolio of companies that are generating cash and able to, and well managed enough to agree to share it with shareholders. And the other thing is that a lot of our shareholders, most of our shareholders are private individuals, and if you're living in retirement on a portfolio, you ideally want to be able to live off your dividends. You don't want to have to sell part of your shareholding. So, and if you go back a very long time, and I have to preface this by saying huge caveats about projecting to the future, but if you go back 47 years or so since we started our current run of dividend rises, the current dividend as a percentage of the share price 47 years ago is about 250%. So rising dividends, even when they grow at only a few, 4 or 5% a year, compound up to something which is both accretive in sort of investment terms and also helps people who are living off institutions live off a sort of broad stream of capital and income. Individuals tend to live off dividends or interest earnings. So.
I've got one more question online that I'm going to take. Are there any more questions from the hall? Yes, please, in the front here.
It's coming.
Colin Peckham. During Andrew's presentation, he mentioned a couple of times ESG-related targets, some of which are in 28 years' time, and then there are smaller targets going forward. My question relates to, I don't know what the timescale are for the smaller individual targets are, but are there any penalties either for the CEO, the board, or the investment managers if they miss the targets, or will it be more like the Tory government, we missed the target, so what?
Well, I mean, I'll leave the chairman if he wants to talk about sort of pushing me under a bus or whatever. I mean, first of all, the one part of my own, if like, variable pay, bonus, call it what you will, that is not that most of it is determined by whether the company's NAV total return beats its benchmark. So obviously that zeroed in the last year or two. But the other part, one of the key ingredients, is whether we are meeting expectations and making progress and marketing ourselves effectively as a fund which is fully compliant with people's expectations for corporate behavior and also the stewardship which we're meant to exercise in holding companies to account for their own behavior. It's not the fundamental justification for our existence is you've entrusted your savings to us to be able to deliver investment returns, but the political and regulatory climate within which those returns have to be earned changes over time, and for reasons that I agree with, but even if I didn't agree with them, you have to go along with it. So I think the answer would be, well, first of all, I guarantee I shall have retired by 2050, which is a relief all round, probably.
Probably dead.
But clearly, if I or Witan as a whole were being held, or indeed any of our managers were falling short of what we regarded as minimum good practice, let alone best practice in ESG terms, we'd collectively be out on our ear. And we would never, if we found a manager, it hasn't arisen, because the one or two managers that we had which had rather thinner coverage on ESG in the last few years were in areas that we were withdrawing from anyway. But if we had a manager who we felt that they were just paying lip service or were blind to our drawing problems to their attention, and they didn't respond to it with a small degree of latitude of waiting for them, we'd get rid of them. And we wouldn't appoint a manager who didn't convince us that they had a fully compliant and integrated ESG process with how they chose investments.
I'm going to take one further question, but we must then move on to the main business of the day, which is an online question, and which I will give a quick answer to, which you may want to add to. The question is, it's quite a statistical anomaly for all six investment managers managing the core portfolio to be below their benchmarks in 2021. Is this because of directions from Witan, or is it just misfortune? So I'm going to say two things. Firstly, it is definitely not directions from Witan. We do not backseat drive our managers. The second thing I'm going to say is that one of the things that encourages me, and Andrew alluded to this earlier on, is it is very unusual for all six managers who operate in very different fashions to perform poorly at the same time. And that is one of the things that encourages me that we may see quite a dramatic recover, because there's nothing to stop them then all doing well at the same time. Should the background change. And slightly perversely, as Andrew said this morning in the board meeting, it's probably a more pleasant position to be in than having 0.5% of underperformance for 10 years in a row, because then you know you're doing something wrong, as opposed to we've got a short-term problem, which is where I think we are.
Yeah, I mean, it is extremely unusual and obviously a source of a degree of disappointment, but the key thing, if you see somebody performing well or performing badly, is that you should be able to explain it in terms of what you thought they were going to deliver. So, and that should make you wary of a manager who's performing well when they shouldn't be, as much as if they're doing badly and you don't understand why. We have looked sort of manager by manager, and they haven't all underperformed at the same time. The problem is that where you've had periods when 2 or 3 managers have outperformed for 6 months, they haven't outperformed by enough to offset one person being right out of time with the beat. So I think we've lived through 2 or 3 extremely unusual circumstances, and accepting that we don't know when those will come to an end, and we always have to be alert to try and avert incoming changes. I think we'll return to form where 3 or 4 years ago we were, I mean, it's like the cake and icing thing. I think we mentioned it in the annual report. The investment performance of our managers is meant to be the cake that shareholders then put a bit of gearing icing on top of to enhance it and make it more palatable. And unfortunately, on this occasion, we haven't had a cake. So, or the cake has been sort of more burnt by King Alfred than cooked by Mary Berry.
I think I prefer the cake analogy to the cowpat, and at that stage, I'd like to proceed to the formal business. We're clearly going to be around here. The whole board will be here afterwards and having a cup of tea with you. So if you have any other questions, please do talk to us individually then. So I'm now going to move to the formal business, and in accordance with the company's Articles of Association, we're expected to decide each resolution on a show of hands. At the appropriate point, please raise the voting card that the registrar has given you when you arrived in the hall. As advised in the notice of the meeting, those of you attending virtually will not be able to vote at the meeting, but if you lodged your proxy votes in advance, these will be included in the results. The proxy votes lodged in respect to the resolutions will be displayed on the screen for your information. Copies of the schedule of the proxy votes are available on request from the Secretary and will be put up on the Witan website. So, the first resolution, I propose the first resolution that the annual report for the year ended 31 December 2021 be received. I put this resolution to the meeting. All in favour? All those against? Thank you. I declare the resolution duly carried. I propose the second resolution that the Directors' Remuneration Report for the year ended 31st December 2021, other than the part containing the Directors' Remuneration Policy, be received and approved. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the third resolution that the Directors' Remuneration Policy be approved. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried.
I propose the fourth resolution, Mr. A.J. Ross be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried.
I propose the fifth resolution that Mrs. R.A. Beagles be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the sixth resolution that Mr. A.L.C. Bell be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution carried. I propose the seventh resolution that Miss G.M. Boyle be elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution carried. I propose the eighth resolution that Miss S.E.G.A. Newbert be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the ninth resolution that Mr. J.S. Perry be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the 10th resolution that Mr. B.C. Rogoff be re-elected as director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the 11th resolution that Mr. P.T. Yates be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. Auditors. I propose the 12th resolution that Grant Thornton UK LLP be reappointed as the statutory auditor to the company. I put the resolution to the meeting. All those in favour? Thank you. All those against? I declare the resolution duly carried. I propose the 13th resolution that the Audit Committee be authorised to determine the remuneration of that statutory auditor. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. Thank you. That concludes the ordinary business of the meeting. We now proceed to the 6 items of special business. The first one relates to dividend policy. The 14th resolution is a proposal to approve the company's dividend policy. Dividends on the ordinary shares are payable quarterly in March, June, September and December. The company's policy is to seek to grow the dividend ahead of inflation, funded by portfolio income, retained revenue reserves, and, if necessary, as part of a defined path towards dividends being once again fully funded by revenue earnings, realised capital reserves. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 15th resolution is a proposal to authorise directors to allot securities in the company up to a maximum of 10% of the existing share capital, subject to the provisions set out in the resolution. I propose the 15th resolution to authorise the directors to allot relevant securities. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution carried. The 16th resolution is a proposal to disapply the rights of preemption in relation to the allotment of equity securities or sale of shares in Treasury, subject to the provisions set out in the resolution. This means that these shares do not have to be allotted or sold to existing shareholders. I propose the 16th resolution as a special resolution that the directors be authorised to allot equity securities for cash and to sell shares held by the company as treasury shares on a non-preemptive basis. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 17th resolution is to seek authority to buy back the company's ordinary shares, is set out in full in the notice of the meeting. Since the year end, we've bought back 20,503,327 shares, including 9,202,407 since the notice of the meeting was published in April. Therefore, the resolution is for authority to buy back up to 107,549,133 ordinary shares of 5 pence, being 14.99% of the ordinary shares in issue today. I propose the 17th resolution as a special resolution that the company be authorised to make market purchases of its own ordinary shares. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 18th resolution is to seek authority to buy back the company's preference shares, is set out in full in the notice of the meeting. No preference shares have been bought back under the authority given a year ago. Therefore, the numbers set out in the resolution have not changed since the notice of meeting was published in April. I propose the 18th resolution as a special resolution that the company be authorised to make market purchases of its own preference shares. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 19th, and you will be grateful to know, final resolution, is a resolution to permit the company to call a general meeting other than the annual general meeting on no less than 14 days' notice, rather than the normal 21 days. In the event that a general meeting is called on less than 21 days' notice, the company must make a means of electronic voting available to all shareholders for that meeting. I propose the 19th resolution as a special resolution that any general meeting of the company other than the annual general meeting may be called on no less than 14 days' clear notice. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. Just before I close the meeting, I wanted to make one final comment. As those of you with eagle eyes will have seen on the slide, whilst the proxy votes in respect of the majority of the resolutions were passed with votes in excess of 93% in favour, in respect of Resolution 8 to re-elect Susie Newbert as a director, that was only 61% in favour. The board understands that the reason for the results is that some shareholders deem that Ms. Newbert not to be independent due to her length of service, which is 10 years on the board. The board shares the widely accepted view that the length of service does not in itself impair a director's ability to act independently, any more than a recently elected appointment guarantees it. The directors wanted Ms. Newbert to remain on the board for a further year, to retain her experience and knowledge of the company, as she is the only non-executive director with more than 6 years' experience on the board. However, she will retire at the AGM to be held in 2023. That now concludes the formal business of the meeting, and I declare the meeting closed. If you've joined us virtually, it would be extremely helpful if you could let us have any feedback on your experience today, particularly on Eleanor's comparing ability.
Masterful, I thought.
either through the chat function on Zoom or by emailing contact@witan.co.uk. Thank you for all those of you who've attended in person, and I hope that those who are here in person would now like to join us for some afternoon tea, which will be served in the cloisters.